Thank you everyone so much for joining us today. I'm really excited about today's session. We're going to take a deep dive into liquidity and how order book and trade data can be used to assess digital asset exchange and market liquidity. My name is Alyssa Ostrov. I'm the Chief of Staff at CryptoCompare. We've recently partnered with Bitstamp to put on today's event, which builds off of our recent jointly released exchange liquidity research report that came out last week. In just a few moments, my colleague James, who's here, is going to walk us through some of the highlights of the report. But if you want to have a read through the report itself, I'll drop a link into the chat in just a moment. The format of today's event is going to be a brief presentation of the liquidity report, followed by a great panel of speakers who will weigh in on the report and on market liquidity. I do want to just take a moment at the start here to recognize that today's webinar and the report were a joint effort in partnership with our friends at Bitstamp. I can't say enough good things about their team. Bitstamp is the world's longest running crypto exchange and ranks in our highest tier in our exchange benchmark report. They've truly built a reputation as one of the most trustworthy and reliable platforms with the best uptime in the industry. Over the last year, Bitstamp have listed 22 new assets and over 70 new trading pairs, while introducing a range of new services, the latest being their new staking service, Bitstamp Earn. We have some great panelists lined up from FalconX, CoinShares, and Flow Traders. I'll leave my colleague James to introduce the rest of our panelists, but I do want to remind everyone that this is a live discussion today, so we'll be taking questions throughout the session. James will be setting aside some time for our panelists to answer these at the end of the hour. So feel free to write in. You have a Q&A function at the bottom of your screens through Zoom. So please do ask questions. We can try to keep this as interactive as possible. Again, thank you for joining us. I'll now turn things over to James to share a bit more about our liquidity report and to kick off our panel.
Thank you very much, Alyssa. Greatly appreciated. So I'm going to try and not fat finger this and share my screen. So let's see if I can do that. Can everyone see my screen? I hope so. I'm very happy to present the Exchange Liquidity Report, which was done in conjunction with Bitstamp. I'm James Harris, the Commercial Director at CryptoCompare, for those that don't know me. Quick word on us. We're a global leader in digital asset market data, and we cater to government, institutional, and retail clients. We have three core data products. The first is a single API to track the entire digital asset exchange ecosystem with market and reference data. We have an investable indices and settlement price business, which we do in conjunction with indexes such as MBIS, SGX, and others. And collectively now we track over $3 billion of AUM across various ETPs and ETFs. We also provide ecosystem research, such as our exchange benchmark report, digital asset management reviews, exchange reviews, and bespoke reports like these. Right, so diving into the report then, we analyzed 10 of our top tier ranked exchange as per our exchange benchmark review rankings. And very quickly, I'll look to run over a quick comparison of API services that these exchanges offer, what an exchange incentive model looks like, a little analysis on liquidity, and then some findings. And bear in mind, as Alyssa said, that you can ask questions in the chat function, which we will tackle at the end of the panel, because I really want to spend most time with our esteemed guests. So these are the exchanges that are reviewed in the report. Bitstamp as a sponsor, obviously one of them, but they are pretty much the who's who of exchanges that you'd expect globally. Now, in terms of the API, actually, when we compare the exchanges, there aren't a lot that stand out in terms of not having functionality. So all of them have WebSocket connectivity. They have full public trade history as a rule and historical data. They provide either level 2 or up to level 2 or level 3 order book data. Which is interesting, but notably more and more exchanges are now offering fixed connectivity, which of course is a nod towards institutional adoption. If we'd done this a couple of years ago, then we would see more crosses in the fixed connectivity column. Just a quick one on LMAX, they're not here because they have a private API only, so we've excluded them, but I understand from Jenna that they will be releasing a public one very, very soon. So in terms of historical liquidity then, most people look at a market and say, okay, how much volume did a certain market do on any given day? And volume simply represents the value of transactions that occur on a given market and provides a basic picture of historical liquidity. So if I look, for instance, for average daily volumes across exchanges in June, apologies, but our editorial process doesn't always last this long. Booking in people for panels and that sort of stuff was a little bit extended. But you can see that Coinbase, Bitfinex, and LMAX trade the most amount of volume in dollar terms across BTC and ETH markets. But historical liquidity is only part of the picture when picking an exchange to trade on. So it used to be that you could say, well, Bitcoin trades $600 million on Coinbase. That means that if I've got a $100 million order on average for a day, I can be a sixth of the volume and not move the price and, you know, cut my cloth accordingly. But that's not the only factor to look at. And actually, when looking at the drivers of exchange volumes are largely a function of two sets of factors. They're off-market considerations, such as what's an exchange's reputation, what's its credibility, its track record, is it regulated, what's its jurisdiction, how strong is its infrastructure, you know, does it have reliable connectivity, is it stable, does it have insured custody for when I'm having to custody my assets? Because remember, these are bearer instruments. Do they use third-party surveillance partners? That kind of thing. And then you look at the on-chain, or the on-market considerations, such as the incentives, like what do the fee models look like? Do they get rebates? What are the other incentives? Before even looking at things like the spread on the exchange themselves and what's the depth of the order book and the perceived slippage from that order book. A funny example of incentives from an exchange in South Korea, I'm not going to name and shame, but sometimes an exchange, especially in the glory days, sometimes an exchange would offer incentives to participants trading on an exchange, requiring them to trade a certain amount of volume to be eligible for some compensation, whether it's a token or whatever it is. And you can see on the left that over a month period, the volumes on this exchange in question were extremely high as people were striving for eligibility. And as soon as that period ended, volumes crashed to lower levels. Now, that might be a harmless example, but these kind of things are actually could be looked at and analyzed when looking for things like wash trading, because incentives work in those kind of ways. So then fee structures become really quite important. And in general, this is a big difference for digital asset exchanges versus traditional exchanges. Traditional exchanges might have a variable fee structure depending on who you are, but there's no difference between, you know, buying or selling or whatever it is. But here in crypto land, because we're talking about bearer instruments, assets, and it's fully funded, you have this concept of maker and taker fees. And by and large, making liquidity, i.e. posting bids and offers, result in lower transaction costs than taking liquidity when you're hitting a bid or lifting an offer. So within that, exchanges have various models. You have a zero maker model, which is favored by Kraken, OKX, and Coinbase, whereby as your volume, which is the number in the black column, increases, the less you pay, tending to zero. And then you've got a balanced fee model, such as Bitstamp, that basically has a declining amount of fees that you pay depending on your volume, but doesn't tend to zero. And then you find that a balanced fee model actually is similar whether you're a maker or a taker. A straight flat fee model, which is a price regardless of how much you trade, whether you're a maker or a taker as well. And then you have a rebate model where an exchange will charge you for low volumes, but the more volumes that you do, they end up paying you back in terms of rebates. This is what the taker fee situation looks like. You can see that fees are slightly higher, but again, balanced fee model comes out as roughly the same. And fees are actually an important consideration when you then look at other factors such as the spread analysis. So spread really then, absent fees, is one of your core costs of trading. And tighter spreads can be a proxy for higher liquidity, but that's not also necessarily the case. But what they are, though, is a direct function of exchange fee structure and the level of competition on the market, i.e. how much are participants competing to be the best bid and best offer, which ends up tightening the spread. So looking at various markets, you see that in the same reference period in June 2021, you saw a spread of 1 cent on Coinbase, all the way to $15 and more on LMAX and Bitstamp. Now, that might then give you an idea that, well, it's not worth trading on LMAX and Bitstamp, but you have to factor in also the fees that you're paying and the actual liquidity that you have down the order book. So it might well be that, yes, a spread is wider, but it might cost you less in total when you consider the other factors. Here we just look at the order book depth analysis, whereby we look at the exchanges and see if we were to move a market by 1%, how many bit up or down, how many Bitcoin could one do? Which is an indication of perhaps the depth of an order book. And you could see that Kraken, Coinbase, and Bitfinex consistently come out as the exchanges with deepest order books. But really what you want to see here are consistent lines, so that when you're a participant on these exchanges, you know what you're going to get. Slippage then is the cost of pushing down through an order book. And we looked at the average slippage on a $10,000 order. And this is where some of the exchanges that might have wider spreads come out quite well. So Bitstamp, for instance, if you wanted to conduct a $10,000 order, has less than one basis point cost, i.e. you would move the spread by less than 1 basis point if you would move the spread at all. And some of the exchanges that might have tighter touch prices, they might show higher slippage depending on what the order books look like. So the key takeaways then, volumes provide a broad level view of liquidity, but they can be artificially inflated, and they can give this illusion of liquidity without being the case. Spreads are dependent on various incentives and the presence of participants that are attracted by those incentives. Depth describes the supply and demand that's readily available for exchanges, but it includes liquidity, of course, from market orders, i.e. the market, the traders that are coming in, hitting those bids or lifting those offers. And slippage measures the direct cost of low liquidity. Where an exchange has low liquidity, you perceive higher slippage. And really, those are the core findings and insights from the research. I want to get onto the panel, which I'm sure is what you've most tuned into. If you did like this report, please visit our website for research. You can find those reports that I mentioned. And I am now super excited to bring in my panelists. Would you be able to put yourself onto video and turn the microphones on? And I'm going to now stop sharing my screen and try not to ruin this one. Great. So now you should see no screen that I'm sharing and just my panelists. Is that right? Great. So I'm super excited to be joined by these industry experts and veterans. I'm joined by Aya Kantarovich, who's head of institutional coverage at FalconX, Danny Masters, executive chairman at CoinShares, and Ed Carlton, institutional digital asset trader at Flow Traders. I've got some questions that I've prepared for them, but please do use the Q&A function for your questions, as it's incredible to be able to access such people. So I'd like to hand over to my guests now. I've done enough talking to introduce themselves. Let's start with Aya.
Sure. Thank you so much for having me, and thank you, Crypto Compare. This was a really phenomenal report. In terms of myself, I lead institutional coverage, as you mentioned, at FalconX. FalconX is a cryptocurrency financial services company servicing institutions only for trading, credit, and clearing. Very excited to be here today and looking forward to the panel.
Thank you so much, Aya. Danny.
Yeah, hi, James. Thanks very much. Congratulations on a great collaboration and putting this report out. I think as someone who comes from the traditional finance world for many years, I think it's really enlightening for newcomers to understand, how this market functions and how it stacks up against, what they might be more familiar with. And I think it actually stacks up quite well. I lead CoinShares as executive chairman. We're a NASDAQ listed company, ticker CS in Stockholm. Stock's extremely cheap. I recommend everybody go and buy it. And we are specialists. We are specialists in really 3 areas. We are Europe's leader in terms of providing access to crypto products, crypto prices, crypto exposure through traditional stock markets. So we list a large number of exchange traded products on NASDAQ, Swiss SIX, Xetra, and Euronext all across Europe. We're a very large market maker in the space, and we also have a number of landmark equity investments that we roll into CoinShares, things like Kamenu, our licensed custodian, and others.
Thank you very much, Danny. And Ed.
Hi, James. Thank you. And yeah, to echo these guys, always delighted to be involved with Crypto Compare events, and obviously great to be alongside such esteemed guests. So as you mentioned, I run, I guess, what we call our institutional digital asset business at Flow Traders. Flow Traders is really known for being a technology-driven liquidity provider. We've been around for 17, 18 years, really with a pedigree from ETFs, and then that's kind of morphed into the digital space, and you know, arguably the #1 guys to go to when looking for crypto ETP liquidity in Europe.
Thank you, Ed. And I see you've got a stress ball. I guess it's the markets, isn't it? Okay, well, look, I'm coming on to my questions, and I'd first like to set the scene a little bit. So to set the scene for the panel, Aya, maybe we can first touch onto the market and trading ecosystem. What does this currently look like in terms of platforms and types of participants?
Yeah, great question. So this actually feeds really well off of the report, where I think you touched on a lot of areas that the industry is trying to evolve from, and that includes fragmentation. So the industry is incredibly fragmented today in terms of the service providers that you need in order to get a trade through. And so previously, in the last, I would say 3 years ago, you would have a custodian on one side, you'd have your lender, your trading. That trading platform could be an exchange, it could be a broker, across the board. And so today what we've done is, you know, really tried to collaborate all of those services into one place. And so you'll have more like PB, prime broker style structures. And these are folks that are either aggregating liquidity or acting as an agency to send liquidity to other places. You still have your core OTC, I almost think of them as wholesale liquidity providers, who provide liquidity for a number of different services, and then the other service providers that you would tack on top of it. So today, in general, it's still a very fragmented space. I would say it's come quite a long way, but it really consists of your trading shops, your lending shops, your custodians, your structured products, as the folks on the line, and as well as wholesalers, and then the folks building bridges in between all of those.
Great answer, Aya. Thank you. Gents, do you have anything to add to that answer?
Yeah, I think just to bring it into a little bit of contrast, again, you know, I spent 20 odd years trading very heavily on markets like the London Metal Exchange, the New York Mercantile Exchange, which is an energy exchange, the COMEX in New York, a metals exchange. And for each of these products at the time, you know, there was only one venue. So, you know, crypto is extraordinarily different in terms of the, you know, enormous diversity. You know, that makes it very, very different. And I think that's an area of unfamiliarity that people coming from the outside experience when they do come in. We get a lot of questions, you know, where should we trade? You know, how should we trade? What's a good exchange? And that's just never really been an issue, you know, when it came to some of these other asset classes, because you really didn't have a choice. So that's just one thing worth noting, I think.
Thank you, Danny. Ed, anything to finish off?
Yeah, the only thing I'd probably add to that is, you know, I mentioned this fragmentation of the market, and I think one thing that is definitely evident is that this fragmentation has led to inefficiencies within the market, and that's, you know, abundant from everything from capital inefficiencies as kind of one of the biggest, I think, bugbears of the market at the moment. Which, you know, it's being addressed, and one of the great things about the digital crypto space is, you know, there's always a willingness and a plethora of people looking to put the, you know, the grey matter together and try and solve those problems. So, you know, it is going that way in the right direction, but it is, you know, something that as market participants you do have to come, you know, head on with it and deal with at the moment.
Yeah, no, indeed. Thank you, Ed. Well, Danny, coming back to you, CoinShares has got a pretty storied history in the space, you know, via the origins of XBT provider and that sort of thing. I also understand that your group does some market making. Could you discuss your origin and how you've come to be configured this way to offer the products and services you do?
Yeah, certainly. I think, James, the phrase would be more luck than judgment, to be honest. You know, my first crypto trade, which predated CoinShares, predated Global Advisors, which launched Gabby, the world's first ever regulated Bitcoin investment vehicle, was done on a private basis. And I sent $10,000 of my own money to some obscure Chinese bank, which was then relayed onto an exchange called Mt. Gox. I think many people in the crypto industry today will have completely forgotten about Mt. Gox. I certainly would like to forget about Mt. Gox. But, you know, it spectacularly went bankrupt, having accumulated over 1 million clients. You know, you need to remember that exchange, the word Mt. Gox, which again, people probably don't know, was Magic the Gathering Open Exchange. And it was an exchange for physical game cards.
Yeah.
And that was the first iteration in the dark early days of crypto trading. We've come a long way since then. So, you know, our first listed product, as you mentioned, is XBT Provider. That's, you know, around 5 billion in assets now alone. And that was the first, I believe it was the first ETP to, it was the first ETP to the marketplace. And at that time, you know, given the fact that we, you know, have to create and redeem shares on a minute by minute basis, it is an open-ended structure, as distinct from GBTC, for example, a closed-ended structure which develops these premia, which can be desirable or undesirable, but ours tracks the price very, very accurately. But we couldn't find any market makers. You know, it wasn't that there were no market makers on NASDAQ, it was that there were no market makers for the crypto behind that. And we ended up actually starting our market making business to support, you know, that activity. You know, wind the clock forward today, there are probably 25 or 30 market makers in XBT Provider now, and we've gone from 100% of the book to 5% of the book. And but we've parlayed that experience, that knowledge, know-how, and connectivity, you know, both through the things we've been talking about like APIs, but you know, banking becomes an issue when you're doing a lot of crypto volume, because you know, again, the banking solutions to crypto have been slow to evolve. It's getting a lot better now. So we are now at a point where we are market making in our own securities. In NASDAQ, we're doing it in our issuer out of Switzerland on Swiss 6, that's CoinShares Digital Securities. And, you know, we are doing cross-market arbitrage, we're doing market microstructure arbitrage, we're doing geographical arbitrage as markets get out of whack with each other. And what I call sort of synthetic arbitrage as well, where, you know, the forward curve can be in price can be represented not just by a futures curve like it is on CME, but also by a funding rate that power, you know, these so-called perpetual swaps. You know, an instrument, by the way, which is pretty unfamiliar, I think, to people coming from traditional assets, but it's very, very common in crypto. So our business is growing very much. You know, it's about 5 billion a month now in trading volume, and interestingly, you know, and I'm not telling you anything that people don't know because our results are public. You know, we made about 100 million bucks in the first half of the year. About half of that was in market making or market infrastructure, as we call it. And you know, the margins of the market makers have been going down for sure. You know, I mean, these margins were hundreds of dollars at one point in time, and they may be only a few dollars, if anything, now. But the volumes across these exchanges has gone up so much that actually this business is becoming, you know, quite vibrant.
Yeah, thank you, Danny. Great answer. Really nice to see the insight of a genuine OG in the space. Ed, Flow Traders is a pure play market maker. Obviously, you cut your teeth in traditional assets, and you continue to provide a lot of the volumes across traditional assets globally. And you're a very important player in the digital asset space as well. Could you talk us through the firm's history in the space and the roles you play in the markets?
Of course. Yeah, so I mean, as Danny alluded to, like, you know, when the first ETPs started getting listed 5-6 years ago, whatever it was now, you know, they really, you know, there was not a plethora of market makers and authorized participants and liquidity providers willing or able to step up to the place. And I think, you know, as I mentioned, you know, we've been around for some 17 plus years and kind of hold quite a strong accolade as being one of the top ETF guys, definitely in Europe, and, you know, trying to do our best globally. And so it was only natural that, you know, we would start to have these conversations with the issuers, saying, look, you know, we're bringing these products to market, but, you know, ultimately, in order for them to be a success, they, you know, they do need, you know, external market making and also this role of an AP, an authorized participant, to provide liquidity to the primary market. And not only it wasn't just purely inbound. Flow traders had the presence of mind to see that opportunity, and to get involved and take the plunge. Now, if it's a matter of just quoting on an existing venue like SIX, a Swiss Stock Exchange, or Citra or Euronext, that's kind of a bit more vanilla, and it's BAU, as you will, in terms of the connections and the settlement. But one of the necessary evils, if you're going to start pricing a Bitcoin ETN or ETC, you've got to roll up your sleeves and get your head dirty and price the spot and the underlier as well. Yep. So that meant that we started to had the need to connect to a bunch of crypto native exchanges for liquidity, for pricing, so trading the spot and then the derivatives and then perpetuals, futures for price discovery, for liquidity, for hedging. And as I mentioned, we're a technology driven firm, so it's very much within our DNA to be able to jump on that. And something that was kind of came out in your report, back in the early days, it was even more so a bit of a hodgepodge of different connectivity styles, whether it was REST, WebSockets, AWS, very few with Colo and cross connects actually on and that's something that as an early mover, you had to deal with, and I think that gave us our edge, the fact that we were able to do that. And what we've then done is very aggressively grow that business over the last few years, to become, as I've mentioned, probably one the top liquidity provider, market maker for the ETPs, both on the primary and secondary market, the leading market maker for the spot and derivatives. And then a knock-on of that, we're also an OTC liquidity provider, spot derivatives and ETPs as well.
Yeah, no, thank you, Ed. And it's interesting seeing the ETP side and the ETF side. The boot's actually on the other foot. The issuers are sort of begging you to make the market as opposed to you saying, "Can we please make a market?" Which is quite an interesting dynamic. Moving on to FalconX then. You offer API and principal trading as well as PV services. Did the firm start with this offering in mind, and why? How has it gone in the direction that it's gone?
Yeah, so back when I was at Pantera, touching on the fragmentation, both that Danny and Ed spoke about, the reason that FalconX really positioned itself in the way that it did was because of this fragmentation that we're talking about. And I really want to nail that point, to the ground, primarily because, and I'm sure, James, you see this as well, more so than us. I mean, the timestamps, if via APIs, don't align between different exchanges. You're spending hours cleaning data. You're trying to figure out what's real versus what isn't. The market is completely not nascent. And so it's incredibly difficult to understand pricing. To your point, price discovery in general is difficult. It's gotten a lot better. With better folks like flow traders and just infrastructure in general, but it's not a nascent market. And so for us, initially wanting to personally try to buy crypto in the space was incredibly difficult. The UI UX at the time across exchanges was very bad. And to one of the questions that was asked in the chats, there was a lot of exchange consolidation happening across the world at the time. You were seeing big, large exchanges consolidate in different geographies, whether it was in Asia, in the US, in Europe, go through massive M&A activity and likely continuing to do so. But there was still missing that bridge in terms of helping to clear all of that data and provide just one entry point to buy liquidity. And so for us, we always functioned as a principal. We made that decision from the start, where traders, specifically only institutions, would face us directly in order to get liquidity, and really wanted to focus on how can we get deep liquidity. And as you mentioned, depth, right? Slippage is incredibly important. We constantly, even today, get calls from clients saying, "Hey, I'm looking at Binance right now, and I see the price here. Can you execute at that price?" And it's like, sure, maybe for a $10,000 order, but for 100 million, that's not the price that you're going to get relative to what you see in the book. And so, really getting sophisticated traders to understand deep liquidity is something that we wanted to get good at and really provide access for institutions across the globe. And so that's always been a focus for us as well, and working with really good market makers like the folks on the call in order to deepen that liquidity across different markets, especially as new ones get on exchanges. To provide that accessibility is something we've been very top of mind for us.
Yeah, no, thank you. So I'm going to move now on to the exchange and liquidity questions that I've prepared. So this is sort of more alongside the report that I outlined. On exchange dynamics and incentives obviously inform the internal selection process when it comes to you selecting exchanges against which you might use to unwind risk and that sort of stuff. But Danny, what are the most important considerations for CoinShares when it comes to selecting exchanges?
Yeah, well, it's certainly no shortage of exchanges to choose from these days. Again, this number, I mean, I think probably the number's around 200. That's probably without even going to the decentralized ones, of which they probably can double it. And I think if you had to classify exchanges, going back to the beginning, there were exchanges that made a decision to remain entirely within a well-defined regulatory perimeter, and there were exchanges that decided to exist as much as they could outside of the regulatory perimeter. And if I name a couple, I think Binance and BitMEX have went a long way, and to a certain extent Bitfinex went a long way before they felt the sort of gravitational pull of regulators. Guys like Gemini, obviously trying to launch one of the early ETPs. Bitstamp took a very early stance on being fully within that perimeter. And if I'm brutally honest, I would say that a lot of the really innovative stuff in terms of exchange products, order types, different derivatives, and so on, proliferated on the exchanges that were outside the perimeter. To the at the expense of the ones who are inside, who I think drag a lot more inertia around with them because of their regulatory status. That seems to be changing a little bit now, and they're sort of trying to merge. And so you're seeing a trend where the more traditional ones and the more regulated ones are trying to issue more products and more perpetuals and options and up-down stuff, and then you're seeing the other players, scrambling really to try and get a foothold within the regulatory perimeter. So things do seem to be tending towards some sort of center, which is an intersection between traditional and digital finance, and people seem to be converging in that space. For us, we were constrained for a period of time, and I remember when we had our first regulatory license in 2014 or 13 to do our Gabby Bitcoin fund. The regulators actually told us which exchanges we could trade on, and I believe there was even conversations, if I recall correctly, with our other regulators around some of the ETPs about sort of who would qualify and who wouldn't. And certainly we had our own due diligence list, and if you didn't pass that muster, and it could be simple things like who actually owns this business, then they wouldn't get in. And it's amazing today, if you try to find out who owns some of these exchanges, you probably have a very hard time doing it. So, I think we tend to, we're not looking to engage with every venue on the planet. There may be opportunities there, very possibly, if you're prepared to take a little more anonymity risk and a little more sort of reputational regulatory uncertainty, then there may well still be, abundant opportunities to deal with those kind of venues. We tend to stick with, I think I would go so far as to say, even if we're talking about China, if we're talking about, any country in Europe or Western or America, I'd say we have a relationship with the principals and we know who we're dealing with, or we can pick up the phone and actually have a conversation. That is kind of important to us. And I don't think we stray a lot further than that, to be honest. So I think in the whole universe of exchanges, we probably don't deal with more than, 5% at most of them.
Yeah, no, thank you. And that's that concept of, we can have this amazing liquidity and volume, but ultimately if institutions can't go there, then it's kind of pointless. Aya, anything to add on this point before I move on?
Sure. Yeah. So Danny brought up a really important point, which is innovation and how fast these exchanges innovate, which is why we've seen some institutions use international exchanges because they move so quickly to provide structured products specifically. At FalconX today, when a client pulls one quote, realistically, we're pulling 50 plus quotes on the back end across 150 different liquidity providers. So we're trying to do that work for institutions so that they don't have to do it themselves. But I completely agree. The only thing I would add in there as well is uptime, which is something that I think isn't spoken about as much, which is, if the market moves 30%, in my opinion, it's unacceptable if an exchange goes down because you can't move your assets, you can't top up on a position, then you get auto liquidated. And these exchanges aren't refunding you on that liquidation. And so, I think that's another big thing to keep in mind as well when thinking about these different exchanges and counterparties is the volatility and what impact that has on their uptime across the exchanges.
It's a great answer, actually, and we all know that in crypto there's the inside joke that when volatility really hits, exchange X will go down. I'm not going to name names. Ed, just looking at the data provisions from exchanges in terms of trade and order book data, how do you assess this data to gauge market liquidity for a given asset, and what are the most important types of transaction costs to you that might inform your strategy?
Yeah, thanks. I mean, in terms of market data, I mentioned we're a tech business, so we consume a lot of data across from various different sources. And one of the nice things I think about crypto world is that the data is actually much more readily available, and obviously firms like yourselves are really helping that along. From very, very high level, the data in a very, very kind of high level place enables you to really specify the kind of the when and where you're going to trade, and ultimately for a firm like us, for means of being profitable or executing a strategy. In terms of the second part of your question was more around kind of like the costs that we look at to assess where and when we execute. Is probably looking at we mentioned, I think, in your report quite a bit, and it may have come up again around kind of the maker-taker fee models, and these different models that vary quite differently from venue. I mean, obviously that's going to have a certain impact, but then we'll also look at stuff like the tick size on the book as well. I think for example, tick size on the book, if it's say a smaller tick size, that will then the focus really is then about having the pricing is less important, and it's more about being first. And if you have on the converse of that would be obviously if it's kind of a larger tick size, then a lot more of it is about that then puts more emphasis on the rebate and being top of book. And that then leads it to itself, I guess, to a certain extent, the latency arms race that we're seeing commented on. But I think, they're probably the two main things. It's kind of the combination of tick size and then the kind of maker-taker rebates, which are applied in conjunction with that. As I mentioned, then there's the two other factors which the variables of that are price, so being the correct price, or often referred to as the fair value. And then the other thing being the top of book, and actually able to make sure that you are winning that rebate. And for a firm like us, being present, having multiple data sources, whether that's across multiple exchanges, multiple data flows from our market making activities, our OTC flows, the flows that we're seeing in the ETPs, both in the primary and secondary, all kind of we consume, and then with our secret sauce and the algorithms and fun stuff that we hold proprietary is how we do what we do.
Yeah, don't worry, I'm not going to ask for any special magic sauce. FalconX, just on this topic, FalconX acts as a principal insofar as it will face customers who might want to do a certain amount of certain $1 million or $100 million or $50 million of Bitcoin, you then make a price, and they either take it or they don't, and then you go ahead and unwind it wherever you can. How much do you use market data to help inform the pricing of those block trades when you're asked for a quote?
Yeah, that's a great question. Quite a bit, especially for being a riskless principal. If we're not a prop shop, we're not taking any of these on our books. So that's very, very important for us, to all the points actually that Ed mentioned. And so we're looking at depth of order books. We're looking at, and I know we'll talk about this as well, but real volume versus fake across exchanges. We're looking at uptime, which again is very, very important. And one thing I do want to emphasize as well, because Ed mentioned this, it is so great that we have, continue to hear more and more folks discuss latency. I think that's just a reflection of the maturation of the space. But that's another thing as well. You want to make sure that when you go to execute on the price, that the price is still there, and that all depends on the latency as well. So that's something that's been in conversation. But yeah, I think market data across the board. The other thing as well that's really important is to know if let's say a client comes to you with an order, are they spraying the market with that order? In that case, you do have prop shops who will trade against that news. And that, sometimes there will be cases in which we will not want to take that order from a reputational risk and brand. So that's another piece as well. And we'll always let clients know if we see, someone asks us for a quote and we see the market already reacting, we'll let them know. So that's another thing that we're looking at, again, within the data. And then just in general, market color in terms of what other institutions are doing as well. Are there resting limit orders on these exchanges and things like that?
Yeah, no, thank you. I really appreciate that. Interesting, the spraying of orders. I mean, that comes down to sort of knowing your own clients. And from my old days as an agency trader, is that you accept that once, maybe twice, but you don't accept it after that. Great. So just moving on to slippage then, which some might say is sort of the true cost of liquidity. Danny, do you want to start? Like, how does your firm in its various guises deal with the problem of slippage?
Well, we do have obviously, a really good team of people that spend a lot of time looking at this kind of stuff and connecting all these markets with each other. And I've been very proud of what they've achieved. And I think you get to judge that when things are extremely volatile and how you come through those kind of periods. Yeah. Both in terms of, not just, your own well-being, but that of your clients and that of your stakeholders, thereafter. And I have to say, we've obviously got a long track record and we've seen some rather extraordinary things. And we've improved over the years on, how we keep going. And the word uptime, applies not just to the exchanges, but to your own company sometimes. and so we've done very well with that. The observation. One differentiation I would make, okay, I know this would be true not just of the order decks on native exchanges, but in our case, and more relevantly, on the decks for the products that we sell. And that's whether there's what I call like a natural marketplace there, and I think there are natural sort of pools of liquidity around crypto, and I can see it in our own products. So. I look at, XBT Provider, as I mentioned before, our single biggest product and oldest product, and still by far, the most active product and the most active ETP in Europe on a given day. And, if I go back to, I think, May 19th, when we had, last, periodic meltdown that we had, I think we pushed close to $500 billion. Sorry, no, let me rephrase that. It was $500 million, of trading that day. And we did a lot, but we still only probably a little bit more than usual, but maybe we were 10% of that, maybe 5 to 10%. There were a lot of other people trading, not just market makers. There was a real deep pool of, because there are 60, I think maybe 70, 80,000 holders of that security now, and it creates a very natural marketplace. Those securities, I should say, a very natural marketplace. Now, in other marketplaces, which include our other products sometimes, and poor old Ed sometimes on the other end of these things. Let's face it, in a market which doesn't have that kind of, local population, if you like, you get hit once, twice, 3 times, 5 times, 10 times, you pretty much, wake up and smell the coffee and you know what's happening. And for, and I would expect Ed, to do that. At that point, the fair value spread may still be narrow, but it may be skewed to one side or other of the marketplace.
Mm-hmm.
And that is what every market maker will do. If you look to the, not just in products, but also in the underlying. If you look in the United States, GBTC, not anybody's favorite product, particularly mine, given the tracking error that it has. But there's no arguing it is an incredibly liquid pool. Yeah. And I think, on a normal day, while we'll do the most, volume of an issuer in Europe, Grayscale may well do 5 to 10 times what we do. And that is a very, very natural pool of liquidity. And it's probably addressing millions of American customers who hold GBTC. So I think it's important when and I think we all need to connect back to those natural pools from time to time, because market makers can only do so much, even when they're, really willing and not spoofing and acting to everyone's best interest. You sort of have to coalesce around where those natural pools are. We're fortunate to have one of them, but they're key to to sourcing liquidity.
No, thank you, Danny. Look, I've got another 7 minutes before I'd like to bring in audience Q&A. So please do keep typing your questions in, and we'll try and deal with as many as we can. Just remaining on that anecdote, Danny, you mentioned that in early May, there was a lot of volatility. I mean, we saw basically the asset class cut in half from a price perspective. So Danny, you mentioned your anecdotes. Aya, could you maybe sort of recount some of the tales of those days? I mean, they were pretty intense. We were seeing exchanges down left, right, and center, price providers struggling to keep up with data feeds, although we were fairly pleased with our performance over those times. But how did you experience it?
Yeah, so it was our best P&L day. I think most service providers will say that. We, it was a great day for Falcon X. We had 100% uptime, which was incredible. We came out of it unscathed, which was really great to see. But, same thing happened. People had assets stuck. For an industry that operates as T+1 24-hour settlement, that becomes really difficult for people to then move money and settle by the T+1. And that creates basically a cascade of delayed settlements that then impact the client. And so having a balance sheet available to help with those was incredibly helpful for us at the time. But it wasn't March of the year prior, which I would say was probably the time I thought I was out of a job. I think Bitcoin hit 4,000 that time. So that was much worse to see. I think this one was, and I mean, Danny, I don't know how many of these you've been through at this point, but it was, okay, well, we've seen this before, thank goodness. Yeah, thank goodness it's not as bad. So I think, what's nice to see is that the infrastructure has gotten so much better that, things aren't breaking the way they used to, and you can still get cash out when you need to. There isn't like a run to the bank or the run to the exchange like you used to see before. So that's gotten much, much better.
Yeah, no, gosh, I remember 2020. I mean, that was existential fear. Like, is this asset class finished? And fortunately, it wasn't. They turned the machine off, and life turned up roses again. Ed, just on that anecdote, I'd love to hear your insights as to what you were doing over those days.
Yeah, I mean, the exact days, I've got to say, hazy as, because so much happens in crypto world at such a quick speed. But I think one thing I'd like to pick up on is actually from what Aya said, and it's on that more kind of recent move, there was definitely that element of kind of, okay, like it was impactful to the market, and it's kind of proper bums on seats time. But at the same time, we have seen it before, and it wasn't kind of a complete a nuance to us, and I mean, fine, not to the exact same magnitude, but last Tuesday when we had a minuscule 10K shift in Bitcoin, these things do happen, and I think it is getting a bit more part and parcel. I mean, for us, look, specifically to flow traders, as I mentioned, we're a legacy firm. We've been around, so we can handle this as we should be able to handle, dealing with high vola, very, very high frequency transactions, and everything kind of stress tested to the nth degree. From we can, a lot of it is kind of consuming the data, seeing how the rest of the market reacts. There's definitely improvements, and we still do see stuff like outages, which are very frustrating. But then let's be honest, problems also create opportunities. The one thing I probably would just mention, and this isn't something that's kind of specific to us, I think everyone in the space has to deal with. I've mentioned earlier, the inefficiencies and capital inefficiencies in the market. I'm sure absolutely everyone is aware, but for the avoidance of the doubt, at the moment we have this very bizarre pre-funded exchange model in a complete absence of a true prime or credit intermediary. So if you're trading on 10, 15 venues, you have to pre-fund it on all of those. If suddenly there's an outage on one, or there's a massive arb opportunity on the other, you've got to move. And it's all very well saying, look, we've got an asset that moves T in crypto world. Well, that only kind of stands up if the withdrawals are going to be there, and you can actually get them out in time, that the mempool doesn't absolutely spike and you're stuck. And then you've also got the fiat leg, which isn't exactly easy because you are relatively limited in terms of the number of corresponding banks at the moment who will allow you to move the capital. So look, there is some fun and games that has to be played around that. So I mean, I think like all of us, it was a very good day of trading. When the dust settled, there was a lot of smiles, and BAU crack on, and the next day, with a 24/7 market, it's not like the bell rings and you can go home for the night. It's just keep on trading.
Yeah.
And if I can just kick in one more thing again, just to put this in a little bit more of a historic context in the traditional markets, let's not forget back in the day when you traded, for example, gold or crude oil, on the Chicago markets, a really volatile day, they just stop the market, right? And everyone goes outside for a smoke, and they come back in when the futures commission merchants have tidied up the margins and repaid everybody. And I was on the exchange floor the exchange could have stopped trading 3 or 4 times in a day when things were really busy, and they literally, there's paper tickets on the ground. So the crypto industry can be very proud of the scale and the scaling that it's achieved. But not only that, don't forget in crypto, Ed mentioned, 24/7, that adds one complexity to it. The other complexity is this auto liquidation method that doesn't happen in any other markets that we've seen before crypto. And that just puts additional strain on the market infrastructure to be able to cope with that, and leads to a lot of these, waves of selling when you see the whale bots, at 2 billion in the last 2 minutes or something like that. That's just the way crypto is. And I think it's a more evolved state. And the fact that, we can go through phases like we've been through even this year, and, to all intents and purposes remain, standing up, I think it's a really good testament to the crypto industry. And I don't think any other legacy asset marketplace would be able to handle it in its current form.
Yeah, no, thank you. There is actually one more question I'd like to ask, and it's to Aya about, so one of the things Crypto Compare doesn't do is it doesn't provide an opinion as to what constitutes wash trading. We do that for various reasons, but we look at these kind of things maybe as a proxy, and so we tend to find that our highest rated exchanges on our methodology probably a proxy for nil wash trading, whereas the lower quality exchanges, the lower rank exchanges might have more of that behavior. But how about your perspective? Is it still a thing? Do you see it across the ecosystem?
Yeah, that's a good question. It's gotten so much better honestly, wash trading hasn't been as big of a topic, top of mind in the last year. Ways that you can measure that is just sending trades and market making on those exchanges to see what's real versus what isn't. And so we haven't had that issue in a really long time. Now that depends on the asset class. I will say the more illiquid the asset class is, the more of that potential wash trading you may see. It also depends on the exchange and the market making rules that they have for each exchange. So we have a market making arm of the business, and every exchange, let's say Binance, is incredibly strict on how you have to market make on the exchange, because from a branding perspective, they don't want to be known as a wash trader exchange. Very similarly, other exchanges have regulation rules, I would say, around how you need to market make, and they will shut you down if you don't market make within those set rules. Whereas other exchanges, I would say more so smaller international exchanges don't have those rules. You can easily just list the token without getting approval from the project, so I would say really anything outside of like the top 10 is where you need to kind of double click, and depending on the exchange and the size of it, and really how the market makers engage with the exchange, but we haven't seen it as much as we used to, which is great.
Thank you, Aya. Okay, well, look, I'm going to jump into some audience questions. It's a shame that anonymous attendee didn't provide his name, but he or she asks a great question talking about market fragmentation. We note 200 plus exchanges. Do you see consolidation happening in the exchange ecosystem? Is it going to be an M&A? And if so, what sort of characteristics will prevail? Open question, who wants to grab it?
I don't mind just jumping in there. For my 2 cents, I think, look, there's something that's already starting to happen. Danny mentioned about it earlier. There's kind of 2 different subsets. There's kind of, exchanges which have very clearly kind of stuck themselves the mast, saying, look, I want to go down this kind of, regulated and very kind of, above board AML, approach. And then there's those which aren't. I think, naturally, like, there's quite a big threshold of being able to achieve that. It's not, the AML KYC threshold of some of these venues to be able to kind of stand up to the regulator. That it's not an easy task, and that's just one thing. And not even talk about them operationally and technically and all these other things. So I think there will naturally be some kind of natural selection, if you will, a bit of evolution in the market, and a few will just fall by the wayside. They will not be able to achieve that. They will either then just kind of give up, or they will go down the other route, which is then to service this kind of the other subsets of the market. Say, look, we don't want to do that. We want to maybe have less rules, less this, that, and the other, and they will service another part of the market. There definitely will be, and we will start to see kind of a few, I'm not saying cream rise to the top, but I think a few bigger players. But I definitely think that for at least some time that we're not going to see kind of a move to quite the days of Daniel was saying, with kind of one omnipotent exchange being like the powerhouse for crypto in Europe and one in the US. I think there's still going to be kind of at least a handful or so.
No, thank you. Rather than sort of take an extra perspective on that question, I'd like to do one more attendee question by Robbie Fung. You mentioned, Danny, the auto deleveraging factor and the liquidations that go through. Is that a concept that you sort of have to be very fearful as a market maker, either directly or indirectly?
I think the crypto community never ceases to amaze me in terms of its innovative innovation, whether it's sort of managing to fund itself without banks, or managing to create markets without futures clearers or buffers or margin calls, all this kind of stuff. It's very, very exciting. People have had different models on liquidation. I remember for the first time, I think it was on my personal account, being liquidated on BitNext when I was in the money. And I didn't even think that was I didn't think that was a thing, So there's all weird and wonderful ways of doing it, and not every exchange follows the same protocol on that. There are, you need to be very, very mindful. Obviously, as a market maker, especially when you're doing some sort of relative value arbitrage in high vol, where you lose one leg because your capital is insufficient, or you indeed make too much money on it and get stopped out as a winner. That is something you have to be very careful of. But I think it's something that clients going to exchanges have to be very, very careful about, because they can make assumptions about how things get liquidated here, or how things used to get liquidated in their Fidelity account for regular assets, and they will not be the same on the venues they go to. So read the small print when it comes to figuring out how they do that.
Thank you, Danny. And unfortunately, that's all we have time for today. I'd just like to say thanks to the attendees. I'd like to say thanks very much to my panelists. I look forward to sharing a cold drink with you very, very soon. And finally, I'd like to say thank you to our great sponsors, Bitstamp, for letting us write this report in conjunction with them, and then being so kind to give us the pedestal to do this panel. So we're very, very happy with that, and we look forward to doing more with them. So thank you once again all, and I wish you a very nice day ahead.